Johnson&Johnson, that absolute legend of a stock and a straight-up dividend king, is chilling right at its 52-week low. Check this out, its 52-week low is hanging around $143 per share, and right now, it's trading at about $146.60. Alright, so this company, which I've hit you up about a couple of months back, has got some fresh updates. Most crucially, they've just dropped their latest quarterly earnings report, and we definitely need to dive into that. So, let's buckle up and get rolling with this analysis. Over the past year, the stock's taken a bit of a hit, down about 9%, and year-to-date, it slipped around 7%. But here's a silver lining, they've just upped their dividend game by 4%, boosting that payout to $1.20 per share, so we've definitely got to talk about that in our deep dive. Alright, let's dive into the dividend metrics for this company. So, the starting dividend yield is sitting pretty at 3.38%. Now, here's where it gets spicy. I was digging into some data recently, and if you look back at the dividend yield history for this company, this is the fattest starting dividend yield they've rocked in the last decade, except for that one blip in March 2020. Yeah, you heard that right, the highest starting yield in 10 years, excluding that March 2020 anomaly. So, here's another nugget. The payout ratio for the company is pretty chill at 33.5%, but then you look at the free cash payout ratio, and it's sitting higher at about 64.5%. Definitely some intriguing stats to consider in our analysis. Alright, diving back into what I mentioned earlier, this company's a legit dividend king, boasting over 50 consecutive years of dividend hikes. Over the past decade, they've boosted their payout from $2.59 to $4.70 per share, and with the latest dividend bump, they're now handing out $4.96 per share. Now, let's talk growth. The dividend growth has been solid. We're looking at a 10-year dividend CAGR compound annual growth rate of about 6%, and over the last 5 years, it's a tad lower at 5.75%. So, they're not just consistent, they're consistently stepping it up. Now, here's where the vibes get a bit shaky. The company's free cash flow isn't exactly booming at a super healthy rate, and we gotta remember, dividends come out of that free cash flow. If we zero in on the free cash flow compared to the dividends paid out, it's clear the cash flow is covering those payouts, but keep this in mind, we're talking about a pharmaceutical giant here. This kind of company needs heaps of capital to reinvest back into the business for R&D and to expand their product pipeline. Obviously, we don't want dividends sucking up all their capital. Speaking of the free cash payout ratio, there's been some slight upticks over the past few years, not something I'm thrilled to see, but it's not a deal breaker overall. Now, let the latest earnings. Johnson&Johnson announced Q1 non-GAAP earnings per share of $2.71, which beat the streets by about 6 cents, and revenue clocked in at around $21.4 billion, up about 2.3% year-over-year, lining up with what the analysts predicted. Let's dig a bit deeper into this earnings report. Kicking off with the 8th slide, we've got some solid insights into the year-over-year sales performance. For Q1 2023, sales were about $20.9 billion, and in Q1 2024, they bumped up to approximately $21.4 billion. That's a nice uptick right there. Moving over to the 12th slide, we get into the juicy parts. Post its recent spin-off with Kimby, Johnson&Johnson now operates primarily into major segments. The largest chunk of their business is the innovative medicine segment, and then there's the medtech segment. To break it down, as of Q1 2024, innovative medicine pulled in about $5.8 billion, while medtech contributed around $2.1 billion. This structure highlights where the growth is happening and where the focus might be shifting, especially in terms of revenue generation and strategic investments. In the breakdown of their capital allocation strategy, Johnson&Johnson clearly outlined their priorities, which gives us a clear view of what's most important to them. Up top, and naturally the highest priority, is organic growth for business needs. For a pharmaceutical giant like this, pouring capital into research and development is crucial. They need to continuously expand their product pipeline as it's the lifeline of their business. So, it's a no-brainer that this is their top priority. Following that, we see competitive dividends listed. As I pointed out before, Johnson&Johnson has a track record of prioritizing their shareholders, having increased dividend payments for 50 consecutive years, a commitment that's clearly important to them. Then comes investment in mergers and acquisitions, which Johnson&Johnson pursues semi-actively. This is another key area where they allocate capital to enhance growth and expand their reach. Lastly, although it's at the bottom of the list, share repurchases are also part of their strategy. The company looks to buy back shares when the right opportunities present themselves. For instance, in Q1 of 2024, the company invested $3.5 billion in research and development and returned $2.9 billion to shareholders in dividends. These figures not only reflect their strategic priorities, but also underscore a consistent approach to capital allocation that Johnson&Johnson has maintained for some time now. Johnson&Johnson's business is primarily focused on the big segments, innovative medicine and medtech. They're expecting slightly stronger sales growth in the first half of the year compared to the second for their innovative medicine segment. On the other hand, sales growth for medtech is anticipated to be relatively consistent throughout the year. From what I've gathered from Johnson&Johnson's earnings call transcript, a major emphasis, unsurprisingly for any pharmaceutical company, is on their development pipeline. This is a theme I touched on earlier, highlighting its critical importance to the company. The CFO extensively discussed how their pipeline is poised to drive significant near and long-term growth across both their innovative medicine and medtech segments. For those interested in the specifics, a visit to Johnson&Johnson's website reveals their development pipeline in detail. You can see which projects are in various stages of development, whether they're in Phase 1, Phase 2, Phase 3, or registration. Currently, there are 95 projects listed, with about 7 of these nearing the registration level. This heavy investment in research and development underscores the strategic emphasis on nurturing and expanding their pipeline, crucial for their sustained growth and innovation in the healthcare field. Now, let's delve into some of the challenges currently facing Johnson&Johnson. Recently, the FDA approved a drug that's very similar to Johnson&Johnson's top-selling drug, Stera. This new competitor is set to launch in February 2025 and is likely to impact the sales of Stera significantly. To put this into perspective, Stera generated sales of around $10.9 billion in 2023, making it Johnson&Johnson's best-selling drug. However, as of now, this new drug is only approved in Europe and Canada, which are substantial markets, but not as large as the US market. Switching gears to legal issues, Johnson&Johnson has been navigating some serious legal waters. They recently settled an opioid-related claim in Washington state for $49.5 million. For a company of Johnson&Johnson's size, this amount isn't earth-shattering, but it's still notable. More concerning, however, are the legal challenges surrounding their talcum-based baby powder. Johnson&Johnson has agreed to pay $700 million in a recent settlement, a significant increase from the opioid-related settlement. But the real storm is brewing over the horizon. Analysts estimate that Johnson&Johnson could be on the hook for $10 billion to $15 billion to resolve a slew of talcum powder-related lawsuits. Considering Johnson&Johnson has around $21.8 billion in cash and cash equivalents, the potential $12 billion in lawsuit payouts could consume about 55% of their cash reserves. This looming financial burden could be a heavy strain on their resources and is definitely a concerning development for the company's financial health. Let's dissect whether Johnson&Johnson, currently trading at $146 and near its 52-week low, is valued appropriately. To answer this, we'll explore various valuation models. Firstly, Johnson&Johnson displays a beta of 0.53, indicating lower volatility compared to the broader market. This suggests a relatively stable investment in terms of market swings. Graham's valuation. Although typically a starting point, Graham's valuation may not be the best fit for Johnson&Johnson due to its specific industry dynamics and current financial conditions. Discounted cash flow DCF analysis. For the DCF, we project future free cash flows with a growth rate of 5.5% based on historical data and analyst projections. Calculating the present value of these cash flows, adding cash and cash equivalents, subtracting total debt, and then dividing by the number of shares outstanding, we arrive at a DCF price per share of $63.99. This figure suggests a significant undervaluation but may be overly conservative or affected by the inputs used. Multiples valuation. Currently, the market comparables do not offer compelling price-to-earnings multiples for Johnson&Johnson, making this approach less useful under current market conditions. Dividend Discount Model DDM. The DDM approach values the company based on its dividend payouts and the growth of these dividends. Assuming a dividend growth rate of 4.5% and a discount rate of 8%, the DDM suggests a price per share of about $148.95. This model aligns closely with the company's recent dividend growth rate and offers a valuation near the current trading price. Average valuation. Averaging the DCF and DDM valuations, we get an intrinsic value of approximately $155.64, which even with a 5% margin of safety, suggests that the stock is currently undervalued. However, with a 10% margin of safety, the acceptable buy price would be around $140.08, while Johnson & Johnson may appear slightly undervalued based on these analyses. Potential investors must weigh the ongoing legal challenges and competition risks. The company's stable dividend payouts and low volatility make it an appealing option for those seeking predictable returns, albeit without expecting substantial growth in dividend payouts or stock price. So, that wraps up our deep dive into Johnson & Johnson. Thank you all so much for tuning in. If you found this analysis helpful, please don't forget to hit that like button and subscribe to the channel for more insights like this. Your support really helps us bring you more content. Catch you in the next video. Please note that the information provided in this video is for general informational purposes only. All information on the site is provided in good faith. However, we make no representation or warranty of any kind, express or implied, regarding the accuracy, adequacy, validity, reliability, availability, or completeness of any information on the site. This video does not constitute financial advice, investment advice, trading advice, or any other type of advice, and you should not treat any of the site's content as such. Do conduct your own due diligence and consult with a qualified financial advisor before making any investment decisions.